Hello and welcome to A Few Minutes with Marcia. My name is Marcia Clark. I'm the Senior Research Analyst for Warren Street Wealth Advisors, and today we're going to talk for a few minutes about the U.S. economy. Is it too hot, too cold, or perhaps just right? Now, at the end of last year, the stock markets in the U.S. and overseas fell like a stone, and commentators were beginning to say this record expansion was over. So perhaps the Fed had increased rates too much, maybe these trade tariff talks were going to stall the global economy, or perhaps the commodity prices are falling like a rock, and maybe that means a recession is around the corner. Well, what has happened since then is actually the U.S. economy GDP came in at a much higher than expected 3.2% growth rate. And that was likely because there's still stimulus for corporations. Interest rates are in fact pretty low still. The trade tariffs have been working their way through without too much trouble, despite a few bumps along the way. And the corporate tax cuts have actually still helping companies make strong earnings. So I think the demise of the economic expansion was probably a little bit premature. And we can see some evidence of this underlying strength in the reported earnings of S&P 500 companies. As they were exiting the fourth quarter of 2018, companies were saying, be ready, we're not going to be able to achieve the same growth rates that we've seen in the past. And so they were reducing expectations for their earnings. What's happened now is that as those companies are beginning to report actual earnings, the bulk of them are higher than those expectations, and the market is reacting well. And we saw the stock market hit a new high in April. Now, it's not a perfect picture of optimism. There are companies that are disappointing earnings, and those companies are being hit pretty hard by investors. But overall, the actual data is coming in better than we feared. As you can see in the chart that I have on slide 4, this is a 6-month return history. We've had the big drop over here at the end of 2018, and then this recovery. This is U.S. stocks on the blue line and international stocks on the purple line. Here in between is the Bloomberg Barclays Aggregate Bond Index, which has also been doing pretty well, which is unusual. So what's happening there? Well, we think that the data does support this idea that the economies have room to go. Stock prices are a little bit higher than they were after the fall, so that's a cautionary note. But overall, it looks like there is decent economic data to support a continuation in the expansion. But you might ask, why aren't bond prices suffering more then? If stocks are going up, usually bond prices go down or stay flat. Well, there is enough fear out there that a recession could be coming to keep investors buying bonds. Even though the yields on treasury bonds are barely higher than inflation, there's still enough fear to keep those bond markets solid. So stocks and bonds doing pretty well in 2019. We always, though, have to be forward-looking investors. So we took a peek at the Conference Board's leading economic index, which was just reported a couple weeks ago. And that index is also still at record highs. It's slowing for sure, which you can see from this leveling out here on the blue line on the chart. This is the coincident indicators, which are also leveling out a bit, but still at good high levels. So on bulk, the economic data is still supportive, though as I say, there are a couple pockets of weakness, so we know everything's not perfect. What worries me most is a possible spike in inflation. The charts on slide 6 show you a couple of data points just to give you a sense of what might be out there. This top chart is personal consumption expenditures, which has dipped lately but is beginning to pick up over here, and the employment cost index. That's the total compensation of employees, which has been on a clear path upward, even again, though it has a slight drop recently. Those two indicate that people have money, and if they have money, they're likely to spend it. And if they increase spending, that usually leads to increased prices eventually, especially if you can combine wages with changes in commodity prices. So we did see this big dip here. This is 2018, but the price of oil, which is on this red line, and the price of other commodities, and I put copper on this blue line, have turned back up again. If those two things go up together, it usually means that employers and businesses are able to increase their prices to the consumer, and increased prices is inflation. Why do we worry about that so much? Well, because the market doesn't think inflation is coming. In fact, federal funds futures contracts are predicting a rate cut, not a rate increase. And if in fact the data promotes inflation, the Fed's going to have to go back to their normalizing posture, this idea of letting short-term rates increase to a level that keeps the economy stable. And if the market's not expecting that, it is likely to react badly, and we could easily give up some of these early gains in stocks and also in bonds. So is the economy too hot, too cold, or just right? At the moment, I think it's just right. Not too hot, not too cold. There's pockets of growth, pockets of weakness. The Fed is waiting to see how the data plays out before they do anything, so they're unlikely to derail the economy one way or the other. So we can't, of course, predict anything very clearly, but based on what we can see right now, we're holding tight, we're staying invested, we think that there's room to run, but we're going to keep an eye open for inflation. And once we begin to see that spark, we're going to make sure that investors broadly recognize this and realize it's not a bad thing, it's just normalization, and that we can keep on our just right path going forward. So that's been a few minutes with Marcia. I hope you found it helpful, and we will talk to you again soon.